Welcome to another edition of Rebellion Research's educational series. Today we're very lucky to have a brilliant options researcher, my friend Paul Boroshin, who's from the University of Miami Business School, has come on today to discuss a question that's really been brewing in the financial circles. Should options be classified as their own asset class? Has the time come? Paul, thank you so much for being on today.
Thank you, Alex. It's a pleasure to be here. That's right. I think in a way options are sort of having their heyday. Of course, a lot of people are remarking about how active option trading has become since the COVID market crash and subsequent rebound. And I think a lot of attention has been drawn to the VIX, obviously, but also, for example, the call-put ratio, how many people are buying one or the other type of option, as people sort of try to figure out whether there's any information to be gained about what might actually happen a bit down the road, or at least what people are willing to speculate on.
Without a doubt, this entire COVID situation was really, like a metaphorical meteor hitting our economy. And so what we've created here are just endless pools of data and ideas that need to be researched by academics such as yourself to come up with questions about our knowledge of how our world works. And options are one thing that have really come into focus, especially with what's happened with COVID. The market's going down by almost half and then rebounding to be nearly positive. It's really unbelievable. Yesterday, my students were lucky enough to have a guest lecture by Boaz Weinstein, the founder of Saba Capital. And Boaz, who's up nearly 100% this year, is talking about Wendy's stock, for instance. Wendy's, in a span of weeks, went from a $25 stock to a $7 stock, and then now it's back to a $25 stock. People had just no information about what was going on. People thought it was the end of Wendy's. They didn't realize that even in the COVID situation, people were buying their hamburgers. And what you had with the options markets were an entirely unbridled jungle, if you will. Certainly to classify them as part of the equity asset class, to me, is just wrong. And I've spoken to a number of my friends and smartest colleagues, and they all agree options should definitely be their own asset class. It should be an official recognition that, honestly, it should come very soon. So let's talk about your recent paper on you wrote. Actually, you have two papers coming out. Do you want to start talking about both of them?
Of course. So actually, one of them sort of speaks to this idea, just, who trades options, why might they trade them, and what can we learn from their trades, which is one about the term structure of the third moment of the option implied distribution for stocks, the skewness, which is forthcoming in Journal of Empirical Finance. And there we find sort of an interesting thing that I think helps make more sense of just what might be going on in the option market, simply because we actually see that in the nearer term options, skewness is actually positively related to future stock performance. In other words, it seems like people can actually predict that the distribution might have a big, let's say, right tail, and therefore returns might be outsized positive, or a big left tail, and returns might be outsized negative. And well, that seems to be borne out in subsequent returns. Whereas if we look at sort of the longer maturity, say options closer to a year to expiration, there actually the relation reverses. And it seems like it's more of like a lottery betting type of investment than where options with the biggest implied skewness.
I'm going to stop you in your tracks there, because you mentioned lottery and betting, and we have to touch the retail aspect of this.
Mm-hmm.
Do you morally and ethically feel that it's right to allow retail traders to partake in the options markets? Do you feel that that's an ethically sound decision?
I mean, so I'm a CFA charter holder, and we actually do place a strong emphasis on sort of the ethical guidance of market participants. And I mean, neither the Institute nor I personally, and of course I'm not speaking on behalf of the Institute here, really has a position on what asset classes individuals should or shouldn't be allowed to trade.
Yeah.
I also think that simply the sort of logistics of prohibiting certain
Yeah,
people from like accessing certain classes would be challenging.
Rebellion's customers span the gauntlet from the largest to the very smallest, both retail and institutional. But I have been surprised by how really the proliferation of options trading among our retail client base. It's really quite surprising to me. I did not expect it, and options have certainly grown a lot since COVID, as people have seen the power and the potential of options. I think there was a huge ignorance about options that that ignorance has started to wash away the last few years. As the market has gotten themselves better educated, but still, one must ask, how responsible is it? But there's nothing we can do. You can't prohibit people. And even with asset managers, what can they do? If a client says, I want to buy XYZ or I'll fire you, what is the broker going to do? So it's a really tough situation. Definitely a slippery slope. I by the way completely agree with you. Without a doubt, I think that volatility in options very much is a soothsayer for the movement of the markets and that specific asset class. Options are used by generally the largest, most sophisticated players most of the time. So whether it's JetBlue wanting to hedge something or Saba Capital wanting to hedge a position, the larger players in options tend to know what they're doing, and they tend to have an agenda that supersedes the shorter term aspects. But with markets that have gotten as volatile as they have, really the S&P has been like a penny stock this year. When you look at the volatility of it, it's just unbelievable.
Right, and in a way that sort of speaks to the difficulty of, let's say, restricting people from access to these highly skewed payoffs. Look at the retail enthusiasm for something like Hertz. A bankrupt company or a near bankrupt company is effectively just an option, right? So even if you prohibit, equity derivatives, you still have very similar types of payoffs that I think arouse a very sort of natural behavioral enthusiasm from retail investors precisely because of these lottery-like characteristics.
No, the lottery-like characteristics definitely make options a much harder to understand asset class, one that takes a lot more to be studied. How do you feel about Myron Scholl's work with Black-Scholes? Do you think that's still relevant in today's world?
Well, obviously, this is still sort of a core part of the business school curriculum, and I think it's a great entry point into sort of a discussion of modeling option prices.
Do you think there's kind of an attrition rate to the relevance of it, or do you think it's going to kind of remain a keystone, if you will? Or I guess that's a tough question. I apologize, but and your thoughts would be lovely.
Yeah, it's hard to speculate. So, let's sort of analogize to the CAPM. Everybody knows there's big problems with the CAPM. There's been a wealth of work about additional risk factors since then, ways to tweak the CAPM. But still, in schools, we teach the CAPM, and I don't expect that to go away anytime real soon. And I expect the same with Black-Scholes. Of course, you can modify the sort of option process to include jumps, stochastic volatility, maybe different interest rates, all of these things. The Black-Scholes, of course, formula doesn't allow you to do. But once you sort of get the basic idea of it, then you can move on to this more sophisticated stuff, I think.
No, that's a great point, Paul. It really gets to the heart of what education is in finance, is teaching a student to understand the core principles so that they can modify finance, and kind of, create their own ability to cause alpha and necessitate their job, whether it be banking or research or portfolio management. So definitely a great point. I'm curious about Miami Business School. Are you guys focusing more on options? Is the course offering growing there?
Well, so especially last year, we had a tremendous a number of students enroll in a master's program, and I taught the mathematics of financial derivatives then. And this year we'll have a smaller, of course, group simply because of the exigencies of the pandemic, but I expect that we'll still have the same sort of offerings. And there's always a steady enthusiasm for derivatives, simply because, of course, among professionals, there's always going to be a place for people who are formally trained in their pricing. And we talk both about futures and options, of course. But I think in a way, maybe even what's going on in the markets today may lead to sort of a greater savviness about derivatives, even among the lay population, so to speak.
I agree. Oh, no, I definitely agree. And I think that's one of the great reasons that there should be a push to make options a defined individual asset class so that the knowledge does disseminate, throughout. But speaking of throughout, the global economy has really kind of taken a turn to a place that I love to talk about and I've written about extensively at Rebellion, which is, for me, a tale of two economies. It's really personified by a picture my wife showed me the other day when we were driving. One store closing, one store expanding, and you've got these two economies where one is dying, struggling to survive on death's door, while the other is seeing record profits. Firms like Moody's and Coupa Software have never had it so good, while obviously all the obvious retailers and hospitality firms are just trying to spare every last dime. Do you see that to continue to play out? What are your thoughts?
Yeah, and this is actually a great sort of thing that one can observe from the options market. There's even right now firms out there, if I look at the Bloomberg terminal with volatilities well over 100 and others with volatilities well in their 30s. And usually, of course, there's pretty strong clustering. So the big firms, especially in the tech sector, is sort of like a quality cluster, will have very low volatilities compared to almost everybody else. And the sort of general cluster of the primary casualties of the pandemic, of course, will have the highest volatilities. And in a way, I think that is what's cool about options, sort of how complete of a picture it can paint for you about, what people might expect for certain sectors of the economy. Because for all the sort of talk that we've had about the VIX, in a way, I think the VIX paints with an overly broad brush. It's just the volatility of the S&P with tech and with retail and with energy all in there. So, when energy is having a sell-off and people rotate into tech, well, the VIX itself, as sort of an average of those, might not pick up too much. But then if you sort of look at it by sector, or as I do in a lot of my research, actually stock by stock, there you actually get a much more sort of complete sense of what the market actually thinks about the prospects of a particular firm or group of firms.
I completely agree. It's actually it makes me think about a paper. The Z-score is a very widely used score for looking at potential bankruptcies, and it's something that Boaz Weinstein brought up yesterday with my students. And it makes me wonder about a paper comparing the Z-score to implied volatility in the options market for foretelling bankruptcies. And I wonder which would have a higher accuracy. That's, I think that would be an interesting thing to look at. I think so much of the implied volatility in the options markets are really a betting game right now on the retail bankruptcies in the next 12 to 24 months. So many firms, they have so many months worth of cash, and it's a question of when this, virus will see some type of, globally accepted medical treatment. Obviously it'd be wonderful if we could have a vaccine, but medical or a significant medical treatment that's accepted. But until that happens, many firms are in a countdown. I don't know of any other time that has ever been like this. It's really, an Earth post COVID. That's really like the dinosaurs and a gigantic asteroid hitting. I mean, this was an economic asteroid, and the ripples will be felt for generations. And the capital movement in terms of, who has it and who will get it. Very extreme, really. So, such an unbelievable hurricane we've seen that's come about. So, and
That's right. And I mean, I think a lot of the sort of common wisdom on this seems to suggest that the big firms, the ones that really can't survive this, will be the winners, and that may not even be that great. The restaurant chains will survive, mom and pop restaurants will close, and I think that sort of paradigm could very well extend to other firms. And this you see in implied volatilities as well, that the smaller the firm, the higher the implied vol these days.
But also, we're talking about the necessity for more data, quicker, faster. In fact, one of the research projects we're doing, our Rebellion research, is using nowcasting on live daily retail data, and to see not only could that have called COVID, but can we use that going forward to help Rebellion move in and out of industries faster than we would have otherwise. So that's a huge question. Nowcasting definitely presents a lot of exciting possibilities. And Professor Marcos Lopez de Prada, who is one of my favorite colleagues from Cornell, and I guess you can call him a friend at this point, has written extensively on nowcasting, and it's fantastic. And I highly recommend. Also, he's written some very good books too. Also, Igor Halperin is another friend of mine. Igor's a very good friend. I love Igor, and he's written extensive. Actually, he just came out with a book with Matthew Dixon on reinforcement learning. I highly recommend that as well. So anyway, well, Paul, do you want to leave our viewers with any parting words today?
Well, so I would simply say that when I started in grad school and I did my thesis on sort of option-implied probabilities of bankruptcy, at the time there wasn't that much work done on it now. And I think now, given all this enthusiasm for, well, first of all, as you say, sort of more real-time data from any alternate source besides just sort of the ticker tape for prices, but also this interest in retail and option investments. I really do think options are sort of having their heyday, and I hope this will extend to academics, and we'll see more and more research about really the novel and fairly profound information that one can elicit from options prices about the macroeconomy, individual stocks, as well as industries.
They say the wise man knows what he doesn't know, and I think that's probably why options scare me, because I know how ignorant I am and how, really, getting back to that term jungle, how large the jungle of options really is. So anyway, I look forward to talking with you again soon, Paul. Thank you so much, and stay safe and be well.
It's a pleasure, Alex. You too.